all of the prior experience that you have informs your current judgments. Okay. So totally yes. So the idea that housing was overpriced, things like that, I feel like a lot of people like to say that nobody knew, housing was overpriced. I think that's total nonsense. It's just like the .com bubble. Nobody knew that pets.com was a scam. Nonsense. Everybody knew that pets.com was a scam. But it was also going from, 10 to 100. So a lot of people wrote it. There's just this idea that everyone was just oblivious to the risks in 2005 is when it really started to heat up amongst the trading community. And then it kept going up in 2006. And, at some point you start to realize, well, this is it's too much. And then as the cracks started to crack, people were, the global financial crisis went down, and then it bounced, and then it went down really hard. And that bounce is where we really loaded up on volatility because it had gotten cheap. Nothing had materially changed. And this is a situation where the paper was, just wrong. And we were able to take the other side of that paper. And it's not like we thought that, the market was going to go to zero, whatever else. But, when you have a bunch of options, you collect what's called gamma. And with that gamma, you can still hedge off your risk on a day-to-day basis. And then you go to sleep with really no position on, and you wake up with a huge short. You cover your short and then rinse and repeat. And that is part of the way we made money. And then at some point you stop buying your hedges because they just keep going down and you let them ride, so you go to bed with a giant delta and you wake up with a bigger delta and you don't cover. And that's how it worked. So being long gamma, long volatility in a situation like that, pretty much every major crash that I've experienced, being long volatility has been very good. Most vol people do well in volatile times. The information that is publicly available, and if you are willing to buy data, pretty much everybody has the same information. So the idea that you are able to beat Susquehanna or Jump or Citadel to the vol game is, again, naive. It's not going to happen because the people that are running those desks are very informed, very smart, and they have systems to beat you. So there is some level of, there's the knowable and there's the not knowable, right? And once you understand that the data set that is finite is already known, is probably priced into the options market or the stock market. And then there is the part that is not knowable, that is non-consensus. That's the trade. Because if you're just doing the same thing everybody else is doing, you're not going to make any money, right? It's a wash or a loss. You have to do something that's out of consensus. So if the perceived fair value in an option is 50 vol and you pay 53, well, the person that sold it to you thinks they're making money, and they're professionals, so they're probably right in aggregate. So you have to do something non-consensus. And in our situation, what we did is instead of hedging a lot of those deltas, we wrote them. And that's one of the main reasons we made money. The more you do something, whether it be hit a golf ball, slash a snowboard, whatever, pick a category. The more you do it, the more you have this difficult to describe amorphous knowledge. And I just chalk it up as wisdom. And sometimes your wisdom is right, sometimes your wisdom is wrong. And if your data isn't complete or mistaken, then you're just wrong. But that breadth of knowledge allows you to identify data that are non-consensus, because the data that is consensus is not actionable, right? It's priced into the marketplace. Everybody knows what Jay Powell's looking at. Everyone knows they're looking at CPI on Wednesday. Everybody knows the same thing everything else everybody else knows that's on Twitter. There is the way you digest this information. And you figure out, okay, well, if storm's coming in, everyone's going to buy umbrellas. Well, I might want to buy gloves or galoshes or something else. There are other second and third order derivatives that you have to be able to figure out. And one of the main reasons I love options is because there are these non-linearities to them. So in other words, if they'll play ball within a certain band and they'll just maybe bounce around and do nothing for a long period of time. But when they break so hard and so fast so as to make people make totally irrational financial decisions. And if you're there to trade with them, you can benefit. And so if they have to get out at any price, if you have a $1 million house and you have to sell it in 10 minutes, that's way different than having to sell it in 10 months. If you have a $1 million house in a community of 1 million houses, well, you're probably not going to lose that much money if you have time to sell it. But if you have to sell your house in 10 minutes, Maybe you get 300 grand. You get whatever the guy that has that money on him right now has. That's it. And if you have to sell it for $10 and you really need that $10, that's the trade. Forecasting, what we do is we do with the change of change. And that's the easiest way to forecast things, because I don't know what Powell is going to do at the FOMC. And if CPI comes in at 12%, Powell's going to say, yeah, we're going to raise, 100 bips at the end of the month or something like that. But I don't know that any more than anybody else knows that. But the difference is that when you have options, you know that there is this convexity to them. And then if you can put trades on that curve someplace, slope of a line tangent to that curve, then you can make statistically more likely bets than just saying, I know what's going to happen in the future. Anybody can buy Apple or short Apple, but in the options schema, the whole options chain, you can put statistically better than average bets on. And maybe you're only getting a handful of a percent of edge in this, or maybe you're diminishing your risk by that same factor. But that is why I gravitate toward options, because to me, they are a risk mitigation tool as opposed to just this, wild way to speculate on where Tesla is going to go on Tuesday. So coming into 2022, we were long vol. We are a long vol. And we actually took off almost all of our market risk at the beginning of the year. So if you said to me, hey, guess what? It's January 3rd, 2022, and this is what's going to happen. Let's look at your book. What's going to happen is the SPYs are going to go down 22%, Nasdaq's going to go down more. Oil is going to go to 130 back down to 100, et cetera. All these things, right? And then I looked at my book and I said, okay, well, we have all these puts on. How's the book look? Great. This book is going to murder. And because you don't really have any directional risk on long. And what you really have is a long volatility downside position. And, we're beating the market handedly, but the market is down a ton. And, those puts have not performed anywhere near as well as I normally would have expected. So let's go back to our previous part, which is the wisdom. So having the trade on that I have on now has made money every other time we've been in a scenario like this. And now it's not losing money, but it's not making anywhere near as much as I would want. And volatility relative to other marketplaces like this has been very non-responsive. So there has not been this panic reach. Somebody has to sell a house in 10 minutes or in a divorce or whatever else. There's been no divorces. There's been none of this panic buying of options, which is panic selling the other way around. So volatility can be very difficult sometimes. I know as much about volatility as I think most people, and the options that I purchased, I thought would do really well in this environment, and they've been okay at best. And that underperformance is something we've spent, a lot of time trying to figure out why and whatever else. And I have some answers to that, and I understand why it hasn't worked out. But if we want to be objective about it and go back to the beginning of the year and say, okay, will this position pay you? I would have said yes. And the answer has been no. Yeah, touching on what we said before, when you're trading with a market maker, like pick Citadel, because everyone loves picking on Citadel. When you're buying options from Citadel, there is a certain expectancy already priced into it. And in order for you to make money, you have to exceed what everyone already kind of collectively knows and understands. So if, we're making a bet on the attendance of the ball game today, well, you think to yourself, okay, well, the stadium holds 50,000 people, and there's some people aren't going to show up and whatever else. So if the mathematical top is 50, then I'll make a bet. And that's kind of the deal. It has to be about exceedance. Your bet has to exceed what the market makers or other market participants are already pricing into those options. And the the rate of change of volatility has not been swift enough, or the vol path has not been steep enough to really trigger those options, those downside put options, to perform. And that is really the root of it. So this idea that there is, panic or people need to really cover their book just hasn't really happened. The sell-off has been 6 months in the making, and there's been plenty of opportunity for you to re-engage. The market's gone up violently several times for you to re-put on your shorts or get out of your longs, whatever. And it's been overall a very orderly sell-off. So even though it's been painful just from a Delta One standpoint, options have been okay. And depending on where you strike them, are they at the money? So are they at the money for 2 weeks? Are they at the money for 2 years? Well, I think that the pandemic really wiped out a lot of systematic vol sellers. Now you have guys that sell variant swaps, and that community's kind of been destroyed. And a lot of other of these people are in Feb 2018 when volatility really went crazy. So a lot of those players that come in and just as a business, sell vol, sell vol, sell vol. They've gotten so beat up, so they're not really a factor anymore. So some of those individuals or groups that suppress volatility are no longer there. So the base effects, the higher level in which we're starting from, is definitely a factor. So if you start with a VIX of 25, it's much harder for to really fake people out because it's already kind of priced in. So those, like, if you go back to October, November last year, and you look at the 6-month forward volatility, it was already pretty high. And then if you go 6 months forward and you look into a few months ago in the spring, it was pretty much right there. So in other words, the VIX futures were pricing things pretty accurately.